Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report, the final weekend edition of 2025. Happy holidays, Merry Christmas to everybody. I hope you had a great week, and thank you for taking some time out of your weekend to listen to our show. Because of the choppy nature of this week, and quite frankly, a lot of people taking the week off, Chad and I managed to record a couple segments early on in the week as daily editorials. I am replaying those for this weekend show, so first half of the weekend show, you're going to get a little bit of precious metals commentary on the gold and silver breakouts. And on the back half of the show, energy, an outlook into 2026, especially on the equity front. I hope you all enjoy this weekend show, and thank you so much for taking all the time you did throughout 2025 with us. We look forward to keeping you abreast of markets, metals, and energy in 2026. Hey everyone, welcome to the KE Report in a daily editorial, Monday, December 22nd, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. Craig's been joining us pretty much every Monday throughout the year and for a number of years on the website. And Craig, I really appreciate you always taking time with us. And I know just from a lot of the emails and comments we get at conferences that we have a lot of listeners that really like hearing from you. We like hearing from you too. You always put a smile on our face. And what else is putting a smile on our face is the metals prices, all-time highs, gold, silver, just keep moving higher. The stocks, depending what time frame you look at, these stocks are multiples higher than where they were earlier this year. So I guess, Craig, a little recap for this year, please. I've been on record saying this is one of the best years in probably 15 years, if not even longer. What's your assessment of how we're ending this year and how this year's played out for gold and silver?
Well, a Merry Christmas, Happy Holidays, Happy New Year, all that stuff, guys. Yeah, it has been quite a year. As you were talking, Corey, I thought, I think we should actually start where we began. Remember how I write my annual forecast, and I always tell you guys and everybody that reads it, I write it for me so that I don't forget what I was thinking back at the first of the year, because, it gets lost in translation. So maybe that's where we should start, because if we go back to this time last year, Trump had been elected. All the rage was how the dollar index was going to soar because Trump was going to try to balance the budget, and Musk and Doge were going to trim $2 trillion in spending. And the dollar index had, from early November all the way into early January, just like it did in Trump's first term, had rallied considerably. And gold had posted a 27% year. And everybody thought, well, gosh, how much farther can it go? And I wrote a forecast saying, maybe we can expect, it's not, gold didn't have a great history of having two good years in a row. So maybe we can just get an average year this year. Again, in the face of all of the stuff that was supposedly moving against us as 2024 came to an end. And so what do we have instead? Gold's up 65% year to date, and silver's up twice that. And so now we got to take a look now and go, okay, what did happen? And will these circumstances that have been pushing the metals higher this year, will they continue into next? Because that's what's most important.
Well, Craig, to that point, do you think we're robbing from Peter to pay Paul? Are we stealing from 2026 to have this kind of rally? Or is it still just a catch-up trade where a lot of this forces that we knew about supply demand for silver, or the industrial demand, or we knew that the central bank buying was underpinning gold, is a lot of that stuff just catching up to where we're at today?
Well, I've been pondering that lately, whether we are taking some gains from next year and plowing them into this year, because this is so unusual. I mean, the other 4 times that gold had posted a 25% annual gain in this century, it followed up, the best year was 2011, where it was up 10%, and all their other years were down. So to go 25 and then 65 is just remarkable. So it suggests there's something structural going on here. And I'm kind of working, I kind of have a working title in my head for this next macrocast that I haven't started to write yet, but I've been kind of cobbling things together. And the working title so far, and actually the working title last year became the title. The working title thus far is, well, Scott's got some words on that. And I'm like, what? My name's not Scott. What does that mean? I think everything changed on Sunday, the whatever that was, 2nd of February, when Trump was signing an executive order in the Oval Office to create, or his intention to create, a sovereign wealth fund. And Besant is standing on his right, and maybe Lutnick was, I can't remember who else was there. And they asked Trump, well, how are you going to fund this thing? And Trump looks at Besant and he says, well, Scott's got some words on that, or some ideas on that, or whatever he said. And Besant kind of shuffles his feet and kicks the ground a little bit and clears his throat like, wait a second, nobody told me I was going to have to speak today. It's a Sunday after all. And it was in his, I don't know, 1 minute statement where he said, we're going to monetize the asset side of the balance sheet. And you guys remember we talked at the end of 2022 how the biggest event of that year was the first weekend of March when the U.S. froze Russia's foreign currency reserves and kicked them out of SWIFT. And I think generally, that was kind of a novel, I guess, statement back then. But now generally, I think people kind of feel that actually was the biggest. Yeah, the war was terrible and all the people have died, but financially, that was the biggest thing that happened in 2022. I think we may look back, thus the working title, that the biggest thing that happened this year was that it all started with that Oval Office meeting in early February.
Craig, this is crazy. Bringing up, I didn't realize that stat of, well, it was 4 times in the last century that gold had over.
This century.
Oh, this
since
century.
2020.
Okay,
Yeah.
got it. Okay,
Yeah.
so yeah, gold has been on a decent run in some of those. Thanks for clarifying that for me. Very interesting to hear. Well, and just see how well these metals are doing, and silver playing so much catch up at the end of the year. But if we're looking at a chart, we're in this territory where what can we even follow? It's all-time highs. This is rarefied air. So what could those looking at charts even use to focus on with these sort of moves and how we're finishing the year just in this area where these metals prices have never been?
Yeah, I'm not sure just a traditional technical analysis helps much. I've talked to Chris Vermeulen about this, and he does the Fibonacci extensions and things like that. Okay, that might be helpful. When you're in all-time high territory, you're in that. I mean, how are you supposed to say, well, the last time silver was at 68, this is what happened next, right? Because it's never happened before. And so that makes just straight up TA a little challenging. But I think what I would stick with is, it's like the old adage, you don't fight the Fed. Don't fight the chart. If you can spot an uptrend, like for example, since the lows in the COMEX silver, I think it was November the 18th, it was a Thursday, and it sold off and tapped its 50-day moving average at like 48 or 47.50 or something. Since that day, you can just draw a line connecting a handful of lows, and silver has been in a consistent uptrend. And it'll take off and shoot higher 2 or 3 days in a row, which is currently doing. And then it kind of flags sideways for 4 days, 5 days, 6 days, whatever, until it gets to that same line again. And then it extends further again. So in the short term, I just wouldn't fight the trend. Now, it's not going to a million, right? All trends end. Nothing goes to a million. And, in rare exceptions, things don't go to zero. So all uptrends end and all downtrends end. But for now, I wouldn't fight the trend. The other one is a longer term thing. And the three of us have discussed this quite a bit here this year. The price of gold made a new all-time high in August of 2020. It then traded sideways for about 3.5 years. It'd go up and went down to 1,600 a couple times. Finally then broke out on the 1st of December of 2023. It then kind of flagged in a little triangle phase until the end of February of 2024. And then on the 1st of March of 2024, it formally broke out. And it has since more than doubled in 21 months to today. Every time it has moved up, it has then consolidated. The moves have generally been 20% higher over the course of 6 to 8, 10 weeks. The consolidations are anywhere from 2 months to 4 months. But it just keeps doing it, just keeps repeating. It moves up, goes sideways, moves up, goes sideways, moves up. This last time it was going sideways all through the summer this year. And the three of us kept talking about, well, boy, the next move, if it keeps this pattern going, is going to take it up to, like 4,200. And it did. Well, it looks like it's breaking out again now. I mean, the next move, add 20%, is what? 5,300? Yikes. But again, till that trend breaks, you might as well ride it.
Well, it's a great point, Greg, and I like the reflection back to the end of 2023. I've been on record over on my Substack channel saying you were one of the few guests we had on that was noting those moves, because we had an all-time monthly high in November of 2023. Same thing in December. We saw actually a new daily high happen on the 1st, and then another one on the 4th, that intraday move, and then the strongest quarterly close and the strongest annual close. And so it was a confluence of events that we're seeing the exact same thing here at the end of 2025. It looks like we're going to have the highest weekly, monthly, quarterly, and annual close again. Does that mean we could see a move set up, like maybe some 2 to 3 months of weakness to consolidate and then another blast higher? Is that kind of what you're alluding to?
Yeah. And it also happened, I remember just as I was getting my start, it happened at the end of 2010. New Year's Eve or whatever the last trading day of 2010 was the same way. And I remember writing it on my old Blogspot site about how it was a superfecta, right? Get all four. So yeah, we're definitely close. Now, whether, whatever it is, Friday the 31st, no, Wednesday the 31st, whether that's a green day, and you end up at all-time highs remains to be seen. We'll know in a week. But yeah, that's what I'm talking about. And again, the trend is your friend. I mean, it's a tired old phrase, but it's true. And there have been a lot of people since gold really took off in that, the second to last move of 20% from whatever the lows were, 2,900 up to 3,400 in early April. Ever since that move, again, it takes two sides to make a market. And there have been plenty of people on the other side saying how gold's overpriced and gold's got to go down to its 200-day moving average and all this stuff without ever recognizing that maybe there's something different going on behind the scenes. You mentioned the what seem to be structural issues on the physical supply of silver. Yeah, that could cause things to really get sideways. The seemingly endless central bank bid for physical gold. All those trends remain in place. And if you're convinced that there's got to be some deep pullback before you get long, there's a lot of people that have cost themselves gains this year by following that strategy.
What are you seeing in the shares then, Craig? We usually talk simply metals focused, but we do get into some of the shares. And quite frankly, look, pretty much all these shares, I'd probably say 95% of the precious metal stocks are higher, substantially higher from where they were earlier this year. But we keep on hearing from especially the metals community that these stocks are still not getting the love that they should get with just how much these metals prices have run. Where do you stand on that, and how are you viewing the shares?
I still don't think they're getting their love. You're right. What's going to happen one day in the shares is they're going to continue to rally between earnings periods. That'll really be a sign. Maybe that'll happen in the first quarter or after the first quarter or fourth quarter earnings during the first quarter of 2026. But for now, it's still just a trade. It's not really anything. It seems like a lot of folks don't look at it anything more than that. Well, we're going to buy them. Once we get a good feel for what the metal price is in this quarter, then we'll wait and we'll see what the production reports are, and then we'll do the math, and then we'll buy the shares, and we'll look for a 10% pop into the actual earnings release, and then as soon as the earnings release comes out, we'll dump that, and we'll go back into whatever else. It seems that's still the pattern. I mean, GDX peaked out at 85 in the middle of October, and then went to 68, and it's just now getting back into the high 80s. I guess maybe it's 90 today. Even though the gold price from the fourth quarter to the third quarter is up, 15%? More than that, maybe almost 20. And so all of these companies are, you thought they had great reports in the third quarter. Oh my gosh. So I do think they're still under-owned. I like to talk about market cap when we look at this. The 5 biggest U.S. stocks are $20 trillion. Agnico Eagle is $90 billion. Let's round up and see if we can do that math. 100 billion versus 20 trillion is what? Help me out. 1/2 of 1%? Does that sound right? Come on, Shad, you got a calculator there, don't you?
It's close enough for
Yeah,
me.
that sounds right.
I mean, it has 1/2 of 1%. There's a lot of investable cash out there that has yet to be put into our sector. And as it comes in, there are just very limited places for it to go. I was asked on Friday in an interview, what's my top pick for 2026? And I was like, oh my God, I hate doing this stuff. But how about the silver miners, if you want to get specific? How many are there? 10? I mean, you guys know this. I don't know if your listeners know. Most silver is produced as a byproduct of lead and zinc and copper. And I mean, how many actual silver miners are there? If silver price continues, like Michael Oliver has said, or maybe the chart would suggest, how do people not want a part of that sector? And with so few options as to what to buy, you just get a lot of dollars. It's like the classic inflation: too many dollars chasing too few goods. And in this case, the goods are the silver miners. So I don't think we've seen, again, if I'm dead wrong and gold goes back to 2000 and whatever, then this entire thesis is blown up. And hopefully we'll have noticed that it was starting to roll over before it got to 2000. But if instead all of this continues into next year, despite the gains you've seen this year, I mean, we're just getting started.
Well, Craig, I just want to circle back to what we were talking about off mic, which ties into this, that if you think about the average quarterly price in Q4, like you say, it's a lot higher. I don't think people realize how much higher it is. Like if you think about the average price in Q3 being 39, and we're now at almost $70. I mean, we were at $69 earlier this morning in silver. That is a huge difference in the average. Maybe the average is 52, 54 for the quarter. We'll see when they put out their numbers. Same thing with gold, though. A huge difference between like 3,500 and where we're at now in the over 4,400. Maybe we're at 4,200 for the quarter. I don't think that the producers are anywhere close to factoring that in yet. So it's not just a quarterly trade on the earnings report. I think that the market participants in right now are grossly undervaluing where the earnings are going to be. So if the price to earnings ratios mean anything, if the earnings go up, if the E goes up, surely the P has to go up. And it's the same thing with the developers. If you have a project that's based on $2,600 gold or $24 silver, and we're using today's spot prices, their charts and their company materials don't even factor this in. So is it possible the market is in just a dizzying spin here? They can't even possibly keep up with how fast the metals prices increased.
Yeah, I think that's right, Shad. I think that's an excellent point. And again, there's still a disbelief, right? It's like I say all the time, it's not the gold that's just expensive. When gold's going up, it's the purchasing power of your dollar that's going down. So people say, well, $4,400, that's up too high. No, actually, your dollar is down so low and has been devalued so greatly that you can only buy half as much gold with a dollar as you could 5 years ago. It's not the gold price going up, it's the purchasing power of your dollar that's going down. And so people look at the price and go, oh, it's too expensive. It's got to come back down. Remember when we've talked too about all of these banks that have their, all of their analysts that cover these shares, cover the mining sector. And they're using, what price are they using for gold in 2026? Maybe I pick one, Bank of America, which trickles down to Merrill Lynch. And I don't know I have no idea what their price project. Maybe 4,000 when the prices. And so when they're recommending that stock to their clients, they're factoring earnings off of a projected price that maybe that is where we'll end up next year, is only 4,000. But that all works into the equation as well. And so I think you're right, Chad. I think a lot of that drop down in October was people thinking that the bubble had burst, and surely silver was going back to 35, and gold was going back down, and so they had to get out of those mining shares right now in this last 2 weeks of October, and they've not fully come back in yet because they can't. Well, there's just no way that price can stay where it is now, without thinking about just how significantly and how many dollars it is these miners are making at these price levels.
So, Craig, let's take this a little further because, look, this is a great environment. We've been talking about that all year. We've been talking about it for a couple of years here. But we do know that metals, resources are cyclical. These bull markets do not last forever, but they can go on for a long period of time. What do we need to be aware of that could give us a sign that maybe this bull market is starting to come to an end, or we are entering the later innings of this rather than just simply getting sucked in and thinking it's just going to keep going up, up every year?
Well, I would, as we talked about earlier, I'd keep an eye on the price. If you notice, instead of a bull market is a series of higher highs and higher lows, there will be another pullback. There'll be another consolidation. And if prices of either start making lower highs and lower lows, okay, well, then we've got something more substantial on our hands. So you've got to keep an eye on price. And then you also got to look at the macro trends. We are currently, again, in another pullback in the dollar index that nobody seemed to see coming. I mean, it got up to 100 a couple of weeks ago, and everyone thought, okay, the low's in, look at the double bottom. And now it looks like it's going right back down to the lows that we saw back in the summer of 96 to 97. If all of a sudden policies change, the Fed starts to not cut, Trump puts in somebody, you remember like sometimes the president will nominate somebody to the Supreme Court that they swear is, like a conservative, and then they get on the Supreme Court and there's some, they side with the liberals instead, like Breyer was back a couple decades ago. I'm showing my age. Maybe Trump nominates a Fed chair that he thinks is going to be a yes man that's going to cut rates like he wants, but instead that guy gets in there and instead doesn't. Things like that could really upset the apple cart. Watch central bank gold buying. If all of a sudden the central banks become net sellers, that would be some supply to the market that we haven't seen in a number of years. That would change the dynamic. So there are all kinds of things that people need to watch. What I would just again caution though is that as we began this call, and we started the year this year thinking, it's going to be a pretty tough year. I mean, the narrative was higher interest rates and stronger dollar and balanced budgets and all that stuff. And look where we are instead. The trend was up and the trend has continued up. So it's incumbent upon the listener to pay attention, ride the wave if the trend remains your friend, but you got to stay sharp too. Listen to you guys every single day will help you do it. You got to stay sharp and pay attention to the shifting sands if everything starts to dissolve beneath you.
Well, Craig, one more thing just to maybe get you to think outside the box. I know we can't predict black swans, but we also can't predict bullish developments that happen exogenously. This has been a weird year in 2025 if we reflect back on it for a couple other reasons. Not just that the central banks are buying, not just that we've seen Western and Eastern investors flying into these things. We've seen the tariffs as a wild card where metal was being moved from London to the U.S. and back and forth for those arbitrages. But we've also seen a company like Tether, the stablecoin, come in and start buying huge amounts of gold with their Tether gold and investing directly in gold royalty companies and now even in the mining stocks individually. It's got other people talking about more of the crypto soldiers coming over and becoming part of the gold army because they're kind of a debasement trade, anti-fiat trade as well. There's more and more people considering that at the end of this year because the cryptos have really fallen short over the last few months while gold and silver continued higher. And we also have this whole thing with the BRICS unit, and everything was speculative on that, and people said that would never happen. And now they're talking about it actually happening. So they're going to back it with 40% gold. And we also have things like silver and gold becoming strategic critical minerals in the U.S. So are there any other of these wild cards that you're looking at in 2026 that are positive things that have happened in the space that nobody saw coming?
That was a great summary, Shad. I'll just throw one more on there, as it was kind of not necessarily a throwaway line. I tucked it in for a reason into the macrocast I wrote a year ago that said, by the end of 2025, don't be surprised if there are some mentions of yield curve control as a policy program for the Fed. Now, there's all kinds of discussion over the last 2 weeks as to whether or not $40 billion a month in T-bill purchases through April are quantitative easing, as if, the term matters. All I know is they're monetizing $40 billion of debt, short end, over the next 5 months. That, by its very nature, quantitative easing or any type of asset purchase like that is intervention in the bond market, is interest rate intervention, is yield curve control. Maybe this is directed to the short end of the curve. Well, what happens on the long end? And I think this is going to be a really big story next year because Besant has also mentioned the melding of the operations of Fed and Treasury together. They need to work together to manage the situation. And if Trump does install a yes man at the Fed and they cut Fed funds rate in half over the course of next year, and if the bond market starts to get away from them and the yields start to spike on the long end, you know what's coming? Yield curve control. It may just be jawboned and covert to begin with, but I think that's coming. And so this is my long answer to your question, Shad. If there's one thing, all those things you mentioned have been drivers this year. What would be one thing that could really kickstart your heart in 26? Yield curve control. And just leave it at that.
There we go. Craig, thank you so much for taking all the time you have with us this year. Look forward to chatting with you in 2026. And for everyone that wants to keep up to date with Craig, if you're not already, just click that link in the show notes. Visit Craig's website, tfmetallsreport.com. Craig, happy holidays, Merry Christmas, Happy New Year. Chat with you in 2026.
Thank you, man. It's been a great year. Let's take some time to reflect and be happy and then turn it on again in a couple weeks.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
From power generation to steelmaking, coal still drives the global economy. And the Coal Trader podcast from Clear Commodity Network is where the industry comes to talk about it. Join me, Matt Warder, and my partner Joe Aldina as we break down the latest trends in thermal and met coal, explore shifting market dynamics, and sit down with industry veterans and executives for unfiltered, insightful conversations. Listen to Coal Trader Podcast on Apple Podcasts, Spotify, or at clearcommodity.net. Clear Commodity Network, digital news on the physical markets.
The dynamics of the natural resource trade changes every day. Get the full view of the commodity markets every week with Commodity Compass, hosted by me, Jennifer Pickerel. From metals to energy to agriculture, we break down the key moves, market drivers, and macro forces shaping the resource world, all in one sharp, insightful podcast from the Clear Commodity Network. Whether you're a trader, investor, or industry pro, Commodity Compass helps you stay grounded and informed. Listen on Apple Podcasts, Spotify, or at clearcommodity.net.
All right, here we are. Welcome back. Now for the replay of Dan Steffens' interview from Tuesday, focused on his outlook, mostly equity-wise, 2026 energy stocks. Hey everyone, welcome to the KE Report in a daily editorial. Tuesday, December 23rd, creeping up here on Christmas. We are chatting with Dan Steffens. Dan is the president of the Energy Prospectus Group. Dan, I've received a lot of questions really heading into the new year, people focused on the stock front for oil and natural gas. And a lot of our followers, I think, know that at the Energy Prospectus Group, you have a number of different portfolios that follow everyone from the big stocks down to the little stocks, and also segregated between growth and dividend plays. We're going to get your outlook for next year, 2026, and some of the companies that stand out to you in all of your portfolios, plus address a few more of the questions that I have received. Before we do, though, time to give a little quick recap to the oil and natural gas markets. I want to start off with the oil markets because oil continues to be under somewhat pressure. We're trading in the mid to high 50s right now. Outside of a run up in June through about 3/4 of June, the oil price hasn't really done much and has been arguably just in a downtrend all year. So Dan, quick recap on the oil market, how it's positioned at the end of 2025.
Well, IEA has been forecasting that the global oil market is going to be grossly oversupplied, and they've been saying it literally for 6 or 8 months. I mean, this is the most talked about oil glut in the history of humanity. I mean, it's incredible. Personally, I think a couple things are going to happen. Number one is U.S. oil production is probably going to go on decline in the first quarter, partly because of weather, but also we're just not completing enough wells. I saw a report that, active rig count's down, the number of completion crews is down. And if you're not completing enough wells, you got constant decline on the existing wells. And so I'm really going to do my forecast for next year. I just decided yesterday I'll start out, and when I break out them out by quarter, I'm going to use 55 for the first quarter. But then I think I'm going to 60, 65, and 70 by the end of the year, maybe. I kind of do that in the forecast models just to show people how much impact it has on their operating income and cash flow. But if oil WTI averages 62.50, it'll be a very good year for our companies that we follow, and because they've really got their costs under control. They're drilling and completing wells for less capex, getting better wells, and that's been holding on. Now in natural gas, it's all related to weather. We had a spike to like 550 in the U.S. when we had a big draw from storage in that cold week about 10 days ago, and now it's warmed up, so we're back below 4. But all my forecasts for the fourth quarter were based on U.S. gas price of 350. And it looks like it's going to be more like 375, 380 for the quarter. So higher natural gas prices are going to offset the lower oil prices that I've used in my models. And most of the companies are going to report financial results about the same as what they had in the third quarter, I think.
Well, Dan, just to follow up on the natural gas price, if we back up the clock a couple of years and you look, you really bottomed back in 2024. And it was down around 170, 160, something like that. And maybe got it down to 150, but it's been on a gradual trajectory higher, even though it's very volatile, I'd say ever since then. So over the last year and a half, almost 2 years, nat gas has been in fits and starts going higher. Do you anticipate that continuing in the year to come? Are we going to get back to the point where we see $6, $7 gas?
Yeah, I don't know if you'll say $6, $7 because in the U.S., if gas gets over $5, then the utilities that can switch back to coal, then coal becomes competitive with natural gas. And in fact, we're going to have to keep some of our coal plants that were supposed to be retired in Texas. They're going to have to keep them open because there's no way that we can meet electricity demand next summer if they start shutting down these coal-fired power plants. But anyway, to answer your question, yes, I do think there's been a structural change in the natural gas market. Number one is we have a significant increase in LNG export capacity in the U.S. I just saw this morning it's like 4 BCF a day, higher than it was a year ago. And then we're adding another almost 3 BCF per day of additional export capacity. And these aren't things just, facilities that are just being talked about. They're almost done. They're almost completed. And these are multi-billion-dollar projects. And they've got commitments to deliver the gas. So, our export capacity by 2032 is going to be double what it is today, in the 35 BCF per day market. And then we're going to get, closer to global gas prices, which today we're looking at $9, $10 gas in Asia and Europe. And we've just gotten, because we have so much natural gas resources in the U.S. and Canada, they can add production, but the thing's going to be infrastructure. We can't build the pipelines, processing, gathering, processing, and storage facilities fast enough. So you're going to have, the LNG exporters are going to be in competition, bidding wars for natural gas supply with the utility companies that supply the gas to your house or business. And so I do think we should see, I expect gas to get into a trading range, maybe in the 350 to 450. Actually, I was just looking at EIA's natural gas forecast, and they are projecting that now, fourth quarter 2026, the gas price is going to be $4.30. And that's because they see the same thing that I see and all the analysts see, that it's going to be, if we just have a normal winter in the first quarter and the LNG exports go to where we think they're going to go, literally record exports month after month after month, it's going to be very difficult to refill storage before the next winter arrives. And so that's why I think if we get to like September, August, September, this summer, and storage is still below average, you could potentially see spikes at $9, $10 gas in the U.S. But those are almost always short-lived spikes.
All right, Dan, well, we'll be following up with you next year in terms of what these storage reports look like and where the price is going. But yeah, 2025 broadly has been just a general higher average price than the last few years. And we haven't really gotten a huge spike except at the end of the year. let's get into those questions. Let's get into the stocks then. Starting off with large caps. What stands out to you in the large cap stocks for the energy sector heading into next year?
Well, on my Sweet 16, I think, a couple of them been involved in mergers, and the merger of Vital Energy into Crescent Energy just closed last week, on Monday of last week, on the 15th. Yeah, the 15th. And the stock sold off a little bit because oil was down that day. But Crescent Energy has a very good mix of production between natural gas, oil, and NGLs. And most of its gas comes from the South Texas Eagle Ford play, which has adequate pipeline capacity. They can get their gas down to the big Gulf Coast export facilities. So I think that one's way underpriced. I'm valuing my pro forma value post merger is $24 a share, and it's just trading in the like 830, 850 range. I think it's a serious double. When you have big mergers like this, especially stock for stock ones, and how many assets are they going to sell? They've announced they're going to sell a bunch of non-core assets. So what's the real production going to be? What's the balance sheet going to look like? What's the year-end reserve report? And I think you don't get a lot of the Wall Street analysts really want to cover it until they've got an audited financials for the first quarter or something. But I think eventually this thing's going to look really good to everybody, especially if gas prices firm up. Of the biggies, Devon's up a little bit this year. It's a good combination of natural gas and oil too. I tell you, Diamondback and EOG, which are really big companies. I mean, EOG is like a 70 billion market cap company. It's down like 15% year to date. And it is in such better shape, and it produces a lot of gas, like 2.5 billion cubic feet a day of gas. So I think it's really underpriced. I'd say it's got 30 or 40% upside. It pays a decent dividend. Yeah, some of these, let me tell you, some of these that pay dividends these are our Sweet 16. One of the stocks I really like is Northern Oil and Gas. It is what they call a non-op company. It does not operate any of its production, and it's pretty large. It's a 2.1 billion cubic or $1 billion market cap, which is slightly below their book value, which is insane because this company is very profitable and pays a nice dividend. In fact, its dividend yield is about 8%. And so it's a good dividend. It's sustainable. They got really good, strong cash flow. I don't see any problem with them continuing to pay their dividends. So the way I look at that is you're just buying them for the dividends with, if the oil price firms up at all, you're going to get a nicer premium. And they do have a lot of gas also. But there's some good company. Now, Vintiv is, one that should be familiar with the Canadian people. It's was in Canna, changed its name to Ovinta. Looks really good. Pays a decent dividend too. Let's see, just 3.2%. Another one, EOG's dividend is 4%, which is pretty decent for a company of that size. And these are really growth companies, not really for dividends, but they're a nice combination of growth plus a decent dividend.
Well, Dan, you brought up growth there. I know that you have a whole portfolio that tracks the kind of mid-size and even small producers that are growing production. Any thoughts on some of the stocks that really stick out in that snack bracket?
Okay, one that really jumps out at me is Baytex. Baytex announced that they're going to sell all of their Texas assets, and the sales proceeds are more than their total debt. So they say they're going to return some of this to shareholders. Now, I don't know if they're talking about stock buyback or whatever, but I think they may be paying a special dividend when this deal closes, and the balance sheet is going to be pristine when this thing closes, because literally the cash proceeds could pay off all of their debt. And then that's going to fund, because they say they want to accelerate the development of their Canadian assets that they have. And it's a pretty big company. I mean, it was 100,000 plus 150,000 BOE per day of production. It pays a little dividend, but it's not really a dividend stock. But I think it's just grossly undervalued. Again, it was trading below book value, which is crazy. The last time we talked, I talked about Journey and Spartan Delta. Neither one of them pays a dividend, but they are in a joint venture up in the Duvernay shale oil play up in Western Canada, and they are reporting. Spartan Delta is the operator, and they have been reporting quarter after quarter of fantastic well results. And it's pulled back. They were both trading at about double where they were. They were up close to 100%, both of them, before this little pullback, but they pulled back to a nice entry price. And actually, Journey, which is the smaller company, it's a 70-30 joint venture, whereas 70% is Spartan Delta, 30% Journey. But for Journey's size, it's a much smaller company, only 200 million market cap. For its size, this deal is very significant for them if they can keep reporting those kind of deals. Now, the one thing that Spartan Delta is, because its production is about 80% natural gas and NGLs, so it also has leverage to rising gas prices up there. So one for dividends in the small cap growth portfolio, which is not really for dividends, but the highest dividend yield is from Riley Exploration Permian, and that symbol is REPX. It pays about a 6% dividend yield, and they have also recently announced they're going to aggressively buy back their stock, and because they think it's grossly undervalued, and so do I. My current valuation is about double what the current share price is.
Dan, I want to follow up on these dividend stocks because a lot of these stocks do throw off dividends. I get that. But even your last example there, Riley Exploration Permian, 6%. There are some stocks out there that are paying double-digit percentage-wise. So what, just in dividend stocks, if people are just looking for the income dividend aspect, which ones are some of the highest payers out there that you like?
Yeah, we have a high yield income portfolio, and it's got 12 companies in it, and they're broken into 3 categories. So I got 3 minerals companies, and these are companies, they don't have any drilling risk because they actually own the minerals. So their revenue streams are what they call royalties, or overriding royalties. And one I just published a profile on last week is Blackstone Minerals. It's a master limited partnership. I know some people don't like them, but it does pay really good dividends, and it is heavily weighted to natural gas. It's the most weighted to natural gas. Now, the one that has the highest dividend yield in the portfolio is Kimball Royalty Partners, and it's a split about 50-50 natural gas and oil. Its symbol is KRP, and at least for this year, now I don't know about next year, but for this year, their dividends are categorized as return of capital. And it is a partnership, but it has elected to be taxed as a C Corp. And therefore, it's not an MLP. You don't have to wait for a K1. You just get 1099 at the end of the year. Now, the biggest one of the minerals companies is Viper. And it was created by Diamondback Energy that spun all their minerals off into Viper. Now, it is more heavily weighted to oil, and it's also almost 100% Permian Basin assets, but it's very big. I mean, this is going to be like 150,000 barrel oil equivalent production per day company, which is much bigger than Blackstone Kimball. And but for growth, it's got the most growth upside, and the dividend is like 5 or 6%. Now, I have 5 upstream companies in the portfolio. They all happen to be in Canada because Canadian companies do pay really good dividends. And the one that really jumps out at me right now is In Play Oil. They hosted a luncheon for us in Houston a couple of weeks ago, and the CEO, Doug Bartoli, I know you've had him on your show a few times. He is super bullish on their new largest shareholder, which is the Delek Group, which now owns like 33% of the outstanding common stock. It's by far their largest shareholder. Delek Group has 2 seats on the board of In Play. And the track record of Delek is and they're a really multi-billion-dollar fund. And when they invest in a company, they invest to build it up and potentially sell it. So I think this is a build up and sell story. It's now producing about 19,000 BOE per day and split, but it's going to get some benefit from rising AECO gas prices, though, because about 30% of its production is gas. The number one, I would say, for natural gas and dividends in Canada is Peyto Exploration and Development. They have an outstanding marketing group. Of all the companies I follow in Canada, their natural gas prices realized are very big, like double some of the other companies, because they're selling a lot of their gas under NYMEX contracts, not under AECO contracts, and they're able to get their gas across the border to U.S. buyers. Surge Energy's in there. I think it is more heavily weighted to oil, but the stock is trading at about a 50% discount to what I think is fair value. The biggest one is Whitecap Resources. I picked up coverage on them when they acquired Varen, and they got a great deal on Varen, by the way. And they really have a lot of running room, but it's much bigger than these other companies. Now, I like Hemisphere. Hemisphere had a little bit of disappointing information for us when they said that their Marsden polymer flood has yet to show any response to the polymers. And Hemisphere is a pure play on oil. It does have a pristine balance sheet, literally no interest-bearing debt, and it pays a real good dividend, about a 7 or 8% dividend yield. Now, the safest places to put your money probably in the energy sector is the midstream companies, because unless we have a major recession, these companies get paid for moving, through their pipelines, through their gathering systems, processing plants, storage facilities. That's what they get paid for. So they don't really have any commodity price risk or drilling risk. And all of them that are in the portfolio, it's Antero Midstream, Enbridge, the largest by far, ONEOK, and Plains All American. I expect all of them to increase their dividends. In fact, Enbridge, ONEOK, and Plains have all told me that they're going to increase their dividends next year. Of those four, the best dividend yield is Plains All American Pipeline. There's two ways to invest in it. It trades as, it's an MLP, Plains All American Pipeline is, and it trades as PAA, but you can buy the general partner, which is taxed as a C Corp, and it does, so you don't have to wait on K1. It pays us the identical dividend, but because its share price is a buck or two higher, its yield is a little bit less. So if you're okay with owning MLPs, PAA is the better investment for dividends, but PAGP is pays identical dividends, and both of them, PAGP is like 8% and PAA is 9+% dividend yield. So very strong, and PAA is trading below book value. No midstream company should ever trade below book value. If they're profitable, they should never be trading below book value.
Well, Dan, there's a lot to loop into there, but one of the questions I want to ask you about is the balance between a company paying dividends, buying back shares, or investing in growth. And they can invest in growth two different ways. They can invest in growth organically within their own portfolio and drill more wells and get more things going, or they can invest in acquisition. Some of those companies you brought up, like Whitecap or In-Play Oil or Viper, all grew all three ways. They grew through paying a dividend to shareholders, returning money that way, but growing their overall portfolio of assets and also growing through acquisition. What kind of a balance do you like to see? Is there any preference that retail investors want versus institutions? Any color around that?
Yeah, they're all these 12 that are in here right now have got growth potential. And frankly, I tell you this, and I'm doing this personally, almost all of my money in my energy portfolio is all invested in stocks that pay dividend, because they're just, when you get those dividend checks every month or every quarter, that just keeps building it up, even if the stock prices don't do much. And my number one criteria is sustainability of the current dividend. Number two is potential to increase the dividends, which I see, and almost all of these, I do see the potential for them to increase, especially the midstream companies and the ones that are a little bit more heavily weighted to gas. But number three, and I'm very much into running room. I call it running room. Do they have growth potential? And Whitecap has a ton of growth potential. Surge does too. Surge, we published a profile on it just the other day. If any of your listeners, want to send me an email or something, I'll send you our profile on these companies, because I just updated them all recently. But Surge just in the last few days. And I think they could really they've got an area they call Hope Valley, and they're drilling these multilaterals. They drill down, straight down, and then they're doing 12 laterals per well. So, this thing down at the bottom of that hole, you got holes going out in all different directions, and is exposing them to really, more and more of the zone. And they're reporting results that are way above the type curves, which a type curve is what the independent reserve analysts give for their estimate of what these wells are going to produce. So when they report results above the type curve, that means they're better than they were expected, better than the economics they expected to get when they drilled the well. And that Hope Valley area is getting, type curves are getting production like 50 or 60% above the type curve. So they look really good. And they've got dozens of more development drilling locations there. They got another area where they're doing multilaterals when they get to the bottom. I think it's called Sparky, and it looks good too. So, but they all have growth, and I'm very firmly want companies that have growth potential.
Dan, how about mineral rights companies or royalty companies in this space? We deal in the metal space and usually royalty companies, which is a little difference between mineral rights and actual royalties, but same idea here. Companies that essentially get money because people are producing on their land, or at least they have a right to some of those revenues. Do you like any of these companies?
Oh yeah, that's what Blackstone, Kimbrell, Royalty Partners, and Viper. They're all minerals companies. And I say minerals, it's minerals and royalties. I mean, their payments are called royalties, but they own the mineral rights. And overriding royalty is a royalty carved out of the working interest. And the risk with an overriding royalty is if the lease expires, that royalty is going to also expire. But mineral rights are perpetual rights. They never expire. But they also have great value. They can be sold, anytime you want. It's just like real estate. You can sell it. So I really like those. Now, there's a Canadian one that I'm going to add in a future newsletter here, Freehold Royalties, which is based in Canada. And I think its symbol is FRU. And it has a 7.2% dividend yield, and it's based in Canada. But these other three, my three are all U.S. companies. Blackstone, Kimbrell, and Viper.
Well, Dan, do you segment by risk inside of your portfolios? Because something that's a dividend-paying stock like a minerals royalty company is pretty safe because they're basically cashing a check for other producers to operate. Like you say, they're not taking that individual risk, but they don't maybe have as much growth as, like, say, a small or medium cap, but it has more risk. So do you diversify your portfolio by the risk of a growth stock versus a royalty minerals company versus a large dividend payer? Do you have that kind of a framework?
Yeah, well, the reason I like Viper, it would be my number one pick for growth, is because Diamondback is aggressively drilling on their acreage, on their mineral rights. So the last time I looked, Diamondback was running 16 drilling rigs on Viper minerals. And so every time they complete one of those wells, then Viper's production goes up and up and up. And it's got unbelievable growth. And in fact, they're going to report a big increase in their production from the third quarter to the fourth quarter because Diamondback dropped down a bunch of minerals into them the middle of the quarter. So the middle of the third quarter. So they're going to have a big jump in their production at the end of for the fourth quarter heading to the year end. They're going to have a tremendous reserve report at the end of the year too.
Dan, let's talk M&A then, because we chat with you every month and we're always talking M&A deals. It does, to me at least, seem like it has still been fairly active in the oil and natural gas world this year for M&A. Maybe we haven't seen the mega deals, but again, a lot of money, a lot of shares have been moving around. Any recap? What's your assessment of how active the sector was this year compared to years past?
Well, we didn't have the big mega deals like, Exxon taking over Pioneer, one of the biggest deals ever. But the year before, we also had Permian Resources taking over Earthstone, which is a smaller company. But I love that deal because Earthstone was one of our small cap growth portfolio companies, and it was grossly undervalued. And they did a stock for stock deal with Permian Resources, and they just got a great deal on that acquisition. And Permian Resources is a screaming takeover target at this price. And I did this for 3 years. I worked on M&A with Hess, and we closed on this is back when $1 billion really meant something. $3.5 billion worth of deals we closed on while I was with that group. And it's a lot of work. It's a lot of work to do it. But anyway, the one I really like, I mentioned Crescent Energy, Vital going, for some reason, and maybe it was because it's based in Tulsa, I don't know why, but the Wall Street gang just did not like Vital. And I think the reason they didn't is because it was like Vital was, in another couple quarters, they're going to start paying dividends. Another couple quarters, then they would announce a big increase in their drilling program, or they would announce a big acquisition of something and put off, and they just got tired of waiting for the dividends. And so they dumped on it, and it was grossly undervalued. But it is doing a stock for stock merger into SM Energy, and SM is trading below book value today, which is crazy. It's literally trading at 50% of book value. And we were talking before, we got on here. Book value is just take the audited balance sheet, take total assets minus total liabilities, and divide it by price per share. And the accounting requirements for these companies that are upstream companies, they have to make mark-to-market adjustments on their assets all the time. So really, any profitable upstream company, especially ones that are generating a lot of growth and free cash flow, they should never be trading below book value. That makes no sense. Why would any company that's profitable, pays dividends, trade below book value? It's crazy. So I really like them. And and right now they make a lot of sense because they may, you save a lot of expenses just having one company that has to be public and then two companies that have to pay the lawyers all the time and accountants. But you also, can reduce the number of people working out in the field if the properties are close together, or you can, reduce the back office staff and stuff like that. So they make a lot of sense that way.
Well, Dan, just pressing the envelope a little bit more on M&A, in addition to those synergies of, consolidating the teams and consolidating some of the overhead G&A expenses, a lot of times they change. The whole pro forma company has kind of a different feel afterwards. So we've just already talked about a lot of M&A. We just talked about the Crescent Vital. We talked about Whitecap. We talked about Viper taking over Sitio. InPlay made a big acquisition earlier in the year. But the pro forma company that emerges after that sometimes has a different feel. And sometimes, to your point, the analysts, maybe they didn't like one or two of the components in separate vehicles, but when they're combined, it kind of makes it more of a juggernaut. So, what kind of an edge can retail investors get by looking at and maybe pouncing on some of these before the street wakes up to the new pro forma company?
Well, I will tell you that 90% of the time the stock goes down after they announce an acquisition, a big acquisition or a big merger. And the reason it is, I think that happens is because, let's say, I call them the Wall Street gang, but the Wall Street analysts, especially the generalist analysts, it is very difficult to build the pro forma forecast model. And they're kind of lazy. So they're going to wait until they get a fresh audited financials or a fresh reserve report or something before they really take a look at it. So the one thing, and I subscribe to the service called TipRanks Premium, and on there they rate all the analysts, the energy sector analysts, from 1-star to 5-star. So these guys that are 5-star energy analysts, they follow all these companies already. So they know how to do a pro forma forecast. In 1 or 2 days, they can add their two models together and do it. And I could do the same thing. And so what I do is I create a pro forma model. What's it going to look like, the next year after this? And that's what I'm looking for, the ones where the Wall Street gang's really missing it, not doing the work it takes to really understand the value of the deal. And if it's an all-stock merger with the Crescent Vital merger and the SM Energy Civitas merger, they're all stock deals, so they're not really overpaying because there's no money. Now they are, assuming the debt of the acquired company. And typically, how these are really structured, when they do the stock exchange, and the acquired company just becomes a wholly owned subsidiary of the parent company, like Civitas will become the wholly owned subsidiary of SM Energy when the deal closes in March. And then it takes a while before you can transition all the assets into the parent company if you want to do that. We usually would wait a couple of years before we did that at Hess.
All right, Dan, you know what? We'll wrap it up here. You've given us a lot of stocks to look into, a lot to really segregate, too, depending on what you're looking for. I know some of these stocks kind of blend some of those categories, especially with the dividend aspect, but you've been sharing that with us all year, keeping us up to date on what you're seeing in some of the more macro reports. And then company news, that's what our audience seems to like the most of. And boy, oh boy, you are on top of so many of these stocks. For all of you listening, you want more information and to keep up to speed with all these stocks Dan's following, go to the Energy Perspectives group. I'll post that link in the show notes. Going to look forward to chatting with you throughout 2026. So Dan, Merry Christmas, Happy Holidays, Happy New Year, my friend.
Yeah, same thing to you guys.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.